Later today, the Fed will release the minutes of the latest meeting, which proved to be an important one, as it had the Fed bending to the pressures of both domestic and international forces that were screaming out to put the brakes on the policy normalization process. A central bank that was positioned to be hiking rates at a gradual pace throughout 2019 had become a central bank that would now be doing nothing this year, with the greater risk, if any move at all, for a rate cut. Looking at the CME's FedWatch tool, looking out to December of 2019, there's about a 2% chance now for a rate hike versus a 13% chance for a rate cut. Clearly, the overwhelming consensus is that there won't be any move in 2019, and all of this is just more of an exercise to highlight how aggressively the Fed has pivoted in recent months. With that said, we suspect that this sentiment will come through in the language of today's minutes, and market participants will be ready to parse away at all of the changes that will reflect the dovish shift. Some of the things to pay attention to include the way the conversation comes off with respect to the outlook for rate hikes. Will the takeaway be more about rates that are now in a comfortable place, or will it be about rates on hold with room for more should the outlook permit? Another focus will be in the area of QT, which the market is expecting will be around October of this year, though there is certainly risk for a surprise with recent comments into today's risk alluding to the possibility that this could occur as early as next month. Such a development would be a dovish surprise and weigh on the US dollar on a yield differential basis. Another conversation worth keeping on your radars is any conversation that revolves around the factors that would have the Fed considering a rate cut. Again, such a conversation would be US dollar bearish on the dovish implications. At the same time, as much as all of it points to what should be a dovish read, that could even turn out to be more dovish than expected, we still believe the Fed will be careful not to completely abandon considerations that would have it pushing rates up again. One such consideration that hasn't gotten a lot of attention in recent years, and for obvious reasons, is inflation. But inflation is something that could come racing back hard and fast, something that would make the whole storyline that much more complicated, as it could put the Fed in a very uncomfortable position where it needs to be thinking about additional rate hikes out of fear rather than a healthy necessity from positive signs around the outlook for the domestic and global economy. Overall, the minutes are positioned to reflect a big-time reversal in the Fed sentiment, which doesn't leave much room for the buck to be feeling good in the aftermath. Technically speaking, if we're using euro-dollar as a proxy, the major pair has been exceptionally well supported on dips below 113 and ahead of the 2018 low from November. We've seen the market turn back up a bit yet again in recent trade. Still, the dollar has been in the driver's seat overall over the past several months, and it will take a break back above the 114.50 area to suggest we're seeing an actual change to the picture. We believe the next break of a meaningful level, either to the top side or downside, could be a big one that leads to a much bigger move over the medium term, but it's going to take a break back above 114.50 or below that 2018 low around 112.15 for clarity. Until then, while the market holds between these levels, there really isn't anything to talk much about as far as directional insight goes. That's all for now.